Well, hello, and welcome to the Mutual Fund Show. My name is Neeraj Shah, and over the next 25 minutes, we'll talk all about how to go about choosing funds within the particular parameters that we're setting for you today. Now, the parameters, or if you will, if you can call them that we're setting today, is that a lot of you might be wondering that with the equity markets at the levels that they are at, and with so many people talking about how interest rates are going to be on their way up, what should you do as a mutual fund investor in terms of building an ideal portfolio of sorts, in terms of the content in the portfolio, not the quantities necessarily, but yeah, the weightages. What are the kind of themes that you should have in your portfolio, or what are the buckets that you have in that you should have in your portfolio, and hopefully within those buckets as well, what are the specific funds that you need to have in order to tide over the next 1 year or the next 3 years in the best fashion, maximizing gains while minimizing risks. And that's what we've requested our two guests to do today, to try and sort of create a portfolio of sorts for you. Kirtan Shah, co-founder and CEO, SRE Wealth, needs no introduction. Has been on our platform a number of times. Kirtan, great having you. Thanks for joining in. And also for the first time on the Mutual Fund Show, Bhushan Mahajan, founder of and chairman and MD of Art Board Shares and Investments. Mr. Mahajan, good having you. Thanks for joining in as well. Okay. So let's take that. Let's put that into context. Kirtan, what would your principal advice be? Let's try and divide it in this fashion. But I first ask you about what should, in a nutshell, in a minute and a half, what would your portfolio be? And then I'll get in the same question to Mr. Mahajan, and then I'll get into details about why you're making those choices. So Kirtan, to you first. What would you advise somebody who wants to build a portfolio as to the components in the portfolio should be?
Hi Neeraj, thank you for having me on the show. Always great to be here. So for somebody who's looking at building a portfolio only for a year, I would definitely not advise going for either gold or equity. So focus is going to be 75% on floating rate funds, that's the debt category, and 25% arbitrage funds. So that is something that you can look at for a 1 year perspective. While you look at a 3 to 5 year perspective, I think 40% in flexi cap, 25% in large and mid, 25% in mid cap, and a 10% global exposure. So that is how I would kind of build a portfolio for the next 3 to 5 years.
Got it. Kirtan, just a quick follow-up. So in the 3 to 5 year bucket, you are doing away with debt completely. You are focusing almost entirely, or actually entirely on equities.
Absolutely, yes.
Okay, I'll come back to the whys in a bit. Yeah, Mr. Mahajan, same question to you. Let's divide this into two again. For somebody who wants to build a 1 year portfolio and somebody who's looking to build a 3 to 5 year portfolio, let's just focus on the what currently, and then we'll come to the why.
Sure. 1 year portfolio, it's very difficult to think about equity. However, in case of debt also, debt has become equally challenging. So I think 1 year portfolio will normally look at either, with a roll down strategy sort of a fund, which is maturing in March, probably, or June, maybe, because there is a huge sort of sword hanging on our heads about interest rates going up. If the economy does well, interest rates will go up. And in that case, a debt investor with total innocence, he might lose if the scenario changes. So that is one area. And second, of course, I fully agree with Kirtan Bhai that arbitrage funds will make a good choice. But in case of arbitrage, I think minimum holding should be at least 6 months or more, because arbitrage doesn't deliver in a linear fashion. Sometimes the opportunities are better, sometimes they are not. So 1 year purely on debt, that too maybe a maturity folio of roll down folio of 1 year maturity from here, and arbitrage in the mix of probably 60-40. That would be my choice. And it also depends on the tax bracket of the investor. If the investor is on the highest tax bracket, probably arbitrage will take a preference. Then it will be 40-60.
Got it. What about a 3 year bucket, Mr. Mahajan?
3 to 5 year bucket, then we can be more relaxed. In fact, we always think that the large caps are the building blocks of any portfolio. So large cap, nowadays, flexi caps are predominantly large caps. So either a large cap or a flexi cap fund will form the chunk of the investment, about 40%. However, we have to understand here that because of this SEBI classification, large caps and index funds, beating index funds has become very tough. That is one thing which we have to think. I would also give, as a tactical allocation, some thematic funds, because if we have 3 to 5 years in our horizon, we have been giving thematic funds for short durations, maybe 1 year or 2 years, like tech funds, digital funds, or a pharma fund, maybe even a banking fund. So some part of the folio will be of that. International funds now, as a matter of compulsion, they have been coming, though we would have preferred to have an international exposure about 5 years ago when Indian economy was struggling and US economy was doing so well. But nonetheless, as a geographical diversification, I look at international funds also. And large and small cap will make the balance. So probably not more than 15 to 20% in mid and small cap funds, about 15% in mid, 5 to 10% in small. But these funds, we have to also remember, they follow a cyclical pattern.
Sure.
So it has to be there for a longer duration to get anything worthwhile out.
Yeah. Viewers, keep in mind, if I can just jog your memory, viewers, to the show that we did the last time, that if you are indeed, for example, taking mid and small cap funds or anything, don't get flustered by short-term gyrations. If your NAV is not quite moving in the same pace, don't get flustered. And the roll down part also very important, because if you're taking some of those debt products in your portfolio, and if the maturities are different from the maturity that you've taken, then it's a problem. And we'll not get into that explanation this show, viewers. If you want to know about that, you need to watch the previous week's show, and we've told about that in great detail to you. Now, Kirtan, let's talk about the 1 year portfolio. Both you gentlemen seem to be in agreement that let's stay away from equities if you are building a portfolio solely for the 1 year. So I get the logic there. Now, what within the non-equity side would comprise in the portfolio? Give us your weightages, give us the reasons why you're choosing those buckets, and if you can add a name or two of the funds that people can choose from there, it'll be more than welcome.
So Neeraj, I think gold and equity will absolutely not make sense in 1 year, because to a greater extent, both of these asset classes over the last 2 years have ran up because of liquidity, right? And today we are at an inflection point where most of us are wondering where is DXY or yields going to move, which is going to have a large bearing on both of these asset classes. So while I talk for 1 year, like I said, extremely specific, I think 75% to floating rate funds and 25% to arbitrage. Now I'll give you a little logic as to why this breakup and why both of these categories. Now, in my opinion, arbitrage funds will really work well for somebody who's in the 30% tax bracket, is because the taxation is equity. So if you hold for 1 year and below, you get charged 15%, and above that is 10%. But I'll tell you a problem that I see with arbitrage funds. So theoretically, it may look really good in terms of lesser tax, in terms of versus a liquid or an ultra. But in the current market scenario where the debt, especially the lower end of the curve, is so cheaply priced at 3.5, that while arbitrage funds are trying to keep something on the debt category to take leverage to short on the future side so that the arbitrage can take place, that part of the portion is really making peanuts. Right? At the same time, we've seen, because of whatever is happening in the market, the futures is to a larger extent a lot of time trading at a discount to the cash market, which is why also arbitrage is not happening. And which is why, in my opinion, arbitrage funds generating more than 4.5 looks slightly difficult in my opinion. And which is why I would have a very small component to arbitrage, which is limited to 25%, even to somebody who's in the 30% tax bracket. And in the same context, I think a larger weight can be given to floating rate funds. Of course, keeping all the technicalities aside of how would a floating work, but in the given scenario, you will generally see that floating rate bonds, which are limited in nature, typically have a higher spread versus a similar kind of a bond in the market with similar maturity profile. That's going to be one additional advantage. And because I'm expecting personally 2 quarters later interest rates to kind of align and start moving up with the economy, these bonds will make more sense in my opinion. So I think on the floating side, I will go with HDFC and Nippon, because these are 2 funds which had average maturities very close to 1.5 to 2 years kinds. And with arbitrage, I'll go with Tata. So that's my composition and reasoning of why.
Sorry, I missed it. Kirtan, with arbitrage, you will go with which fund?
Tata arbitrage. Yeah.
Okay, fair call. Thanks, Kirtan. Thanks for the logic. Now, Mr. Mahajan, to you as well, the 1 year composition the why and the what within that those buckets. Can you tell us?
I'll come to arbitrage first. I'll add to Kirtan wise this thing. But in arbitrage, what we have found that if you have to really get 4.5% returns, the entry and exit has to be on the last Thursday of the month, because that is the time when the arbitrage ends and the investor gets the best return, because it doesn't work like a liquid fund. Liquid fund, at least some NAV portion goes up every day or maybe in a week
Sure.
5 times. But in case of arbitrage, it happens if you enter and exit on the last Thursday. So that is one thing which we keep in mind. And that is why we have been asking for at least 6 months duration. Number one. Number two, I have found that in many funds, I mean, they're really not comparable, but many funds in a month, they will really perform outstanding results. And next month, they will not be in line with what we expect out of a liquid. So generally, on the long-term basis, I would also, Edelweiss has been little aggressive. Edelweiss fund, that is one good fund, arbitrage. And even Tata I like, Tata arbitrage fund I like. So these are the two ones. In case of debt, though I agree with the theme of floating debt, I would rather go with maturity profile of that short-term fund. Like probably, if I remember rightly, Axis is one which has a PSU and short-term debt fund which has a maturity around May, June next year. So that, because here what we have to remember is we have to really convince our client that your returns in the short term are not going to be great, but you have to be ready for that interest rate cycle. Even DSP has one fund in that bracket. I believe DSP Corporate Bond Fund has similar. They have funds right now in cash. Even Mahindra Manulife has been gathering in their new fund, though it needs to be seen how it performs. They are mostly in cash and would rather take a call when the interest rates really change and move. So after looking at Mahindra's performance for some time, because it's a new fund, otherwise these two established funds are there where I'll put my money.
Okay. So viewers, well, that gives you some sense of where you should park your money. Ideally, if you have a horizon of less than a year. Now, keep in mind, just so that you understand this, that both the guests are saying that irrespective of your bent towards equities or debt, but if your time horizon is a year or less than that, then equity, in words of Kirtan, equity and gold are out of the question. And in terms of Mr. Mahajan as well, he's not going with an equity allocation. He's sticking to non-equity allocation when it comes to investments for less than a year. Now, Mr. Mahajan, the second part of this conversation, I'd like to start with you. For somebody who wants to invest for 3 to 5 years. Now, again, you've given us the what will be there. Now, give us the why, or what's the rationale for that. And if you can supplement that with a couple of options that investors can look at, it'll be more than helpful.
Before that, I'll just give one caveat. Like I had one anecdote to share about 5-6 years ago when Narendra Modi was yet to be Honorable Prime Minister of this country. One of my clients came to me and he said, I have money for 2.5 months. And then no sane person would have invested in equity for 2.5 months. So he said, I want to invest in equity. मैंने कहा यार आपको अगर उतना risk appetite है, I mean, are you ready for if he doesn't get elected, maybe another 5% or 10% down market? He said, I am ready to take that risk. So we put his money in an index fund that time. That was in, I think, April or March 2014. And 2.5 months, he got about 12.5-13% returns. So what I'm saying is that it depends on the risk.
Of course.
He was lucky also, and Prime Minister was also there. So BJP coming in with something majority, but it could have gone the other way around. So best way is to avoid equity, unless जैसा कहते हैं कि people are ready with the worst possible scenario in mind. Okay. So having said that, in 3 to 5 years, as I said, I have an inclination to give some tactical allocation, maybe up to 10% in the portfolio. We have done that in the past, and we have found it to be extremely useful to create that alpha in the company. Like till banking and finance came under trouble, we used to give that banking as one of the thematic plays. After the pandemic, we have given pharma and IT funds, digital funds, They have worked well, and now as the results have been coming out, it seems that it's a structural story. It's a structural story for next few years. So I wouldn't mind taking that particular risk after explaining the client that this is the risk which you are taking, but they have to be viewed at the FMCG stocks at little lesser valuation, something like that. Even uh, pharma story also, pharma industry has been reeling for a very long period of underperformance. So this 1 year of 100% returns doesn't mean that you have to really dump it. Maybe it will give you index beating returns for a period of next 1 or 2 years. We have to be alert to get the client out of the thematic funds, because earlier we have had many experiences when infrastructure funds did well in the last bull run 2003 to 7, and people continued to hold them for years together for a total misery of returns. So that the responsibility lies with the distributor of pointing out that the
Sure.
period is over, and now maybe you switch it to normal standard diversified. So diversified equity, yeah, it has become almost synonymous with a flexi cap fund nowadays, because the fund manager has a freedom to move from large cap to mid cap to small cap. So that freedom does wonders to the portfolio. As I said earlier, it has become very tough to beat the benchmarks, though there are funds which have beaten SEBI's official benchmark, particularly in
Sure.
case of large cap. But being the choice being very restricted, again, choice being very restricted only to the top 100 stocks. So I think large cap outperformance is tough, but still I would prefer to make it my building block, maybe about 40%, because these are the most researched stocks, and negative surprises generally will not come. Whatever negative surprise will be absorbed by the market as long as it has a good following. So, and particularly in this age, when foreigners calls call the shots majority, so large cap, sticking to large cap becomes a very safe strategy.
Sure.
So 40% will be large cap. International exposure, as I said a little while ago, that I would have loved to have higher international exposure of at least 20-25% in the last decade, because I repeat, last decade belonged to US.
Sure.
They had a real rate of return of at least 6 to 7%, whereas our real returns were hardly 2-3%. Add to it our inflation, probably 5-6%. Inflation was also low. That was the time probably to look at foreign funds in total. I mean, 20-25% exposure would have done well. Now for geographical expansion, because see, one country is enticing us. You will find that the entire world has gone up. When
Sure.
we talk about Warren Buffett indicator, we find that in China, they are resting at hardly 67%.
Sure.
So that, because of so many reasons. I mean,
Of
China
course.
regulation is also there. So let's not talk about anything political. But
Sure.
so that becomes a very attractive bet. So maybe I don't mind giving some exposure to China and some exposure to the rest of the world. Here
Got
we
it.
have few funds which are
Mhm.
long tested. Like one of the oldest funds in this category was ICICI US equity. Motilal Oswal has also come up with the recently S&P 500, but we
Okay.
like to see for some more time. PGIM has a global equity fund which is also doing well. So amongst these three funds, we'll select. Though it is beyond doubt that stocks like Apple and
Got it.
Amazon,
Got
Google
it. Got
are
it.
known to do well. So it will be predominantly US based, but still. And now this year, just to add last line, we feel that US old economy stocks will also do well. So
Okay.
that we need not be totally focused on FANG. There's a lot of money outside FANG also doing well. So I
Okay.
think these are the few reasonings which I would give.
Okay. Just very quick follow up there. I didn't get the names on the flexi cap side that you would choose.
Oh, yeah. I'm very comfortable with, again, PGM FlexiCap, number one. Even Axis FlexiCap fund, both have done fairly well, according to me. The portfolio construct is good, and both have a different style of management. One sticks totally to growth, not totally, but predominantly to growth. Other one is more keen on finding out newer opportunities in either space. So we like both the funds, and we have been following them for last 3 years, more than that. But since the fund managers changed last 3 years, more keen. So these two funds I like.
Okay, great. Thanks for that, Mr. Mahajan. So that's a detailed explanation, viewers, for that aspect. Now, Kirtan, the same thing to you. We know the what, Now, the why and the components within that why.
So Neeraj, my allocation, and I leave it from where Mr. Mahajan stopped. My allocation is mixed across international and domestic. Of course, 80% of the component is domestically fixed, but I would like to start my conversation with the international exposure first. Now, Neeraj, if you look at the last 10 years and 10 calendar year performance specifically, the top 3 countries which have worked across all countries in terms of absolute return is US, China, and Taiwan. Now, of course, 80% of component has to be focused on India, but there is no reason that I see why we should not have very specific, concentrated allocation to US, Taiwan, China, and of course, then India. Now, of course, the argument will lay as to how China is going to work out with the regulatory challenges around manufacturing and all. So you have to be very specific in terms of what fund are you choosing so that the exposure in China or so that the exposure in the US works out well. So we've identified funds which we think will work the theme really well. So though I've taken an India-specific domestic fund, which is the PPFAS FlexiCap fund, but it has 30-35% exposure to specifically US international equity. So that's where technology play of the US comes into picture, right? And I've also taken Edelweiss Greater China Offshore Fund, where it has exposure to Chinese, Hong Kong, and Taiwanese businesses. Now, if you very predominantly look at it, the focus is healthcare, technology, and pharma. So it is not to do with manufacturing, which we are seeing going through trouble because of the economic challenges and all. So that's my exposure to international. And that is how I think a global diversification will happen. Talking to you of India, I think, look, we are very clear that in our opinion for the next 5 years is actually not going to be the new economy, but the old economy stocks that will work well. Why do we make that comment? I think four specific reasons. First is global growth. Now we've seen this time around 10 trillion worth of liquidity is pumped in by the central government. You've already seen US have 1.9 trillion of infra spending that they've done. Another 2 trillion is under consideration. Europe is also looking at a 750 billion of infra spending. So even if the global growth moves up by 1%, there is definitely going to be a 0.3, 0.4% pump up in Indian GDP. That's how specifically the old economy stocks, in our opinion, will really do well. Again, specifically to lower interest rates, which is my second point. Of course, all of us are expecting rates to go up, but very specifically, versus pre-pandemic, today we are at 180 basis point lower on repo. We are at 225 basis point lower on repo and 180 on GSEC. Even if 25-50 basis point really has to go up, that is still much lower in terms of interest rates than we were at pre-pandemic. Another reason why world economy will do really well in our opinion. Now, if you look at capex, and I specifically talk about housing, right? Today, the housing price to income ratio is at 4.5 times, which has been the best in the last 2 decades. Interest rate today, you go and pick a home loan, it's at sub 7%, which 3 years back was 9.5%. Again, we don't see a reason why housing and the ancillary sectors will not do well. And of course, all of us know PLI, how PLI has been really helping the China plus one theme. We've seen mobile handset imports have already become almost zero because of the PLI scheme. And which is why I think the old economy stocks will really do well. So keeping the old economy stocks in mind, our domestic focus is the Canara FlexiCap, Kotak Equity Opportunities, and Axis Midcap. So that's how we've split Indian domestic and international exposure to put together, and that's our why.
Interesting. Just a quick follow-up, Kirtan. You mentioned the Parag Parikh FlexiCap Fund. One concern that I've found people citing is that the AUM is no longer what it used to be, and could the alpha that is generated could it go down, because it's had a fabulous last 5-6 years, but what if that changes because of the higher AUM?
So Neeraj, in my opinion, the FlexiCap fund still, because of the flexibility to be able to invest across large, mid, and small, will have these challenges much lower than what we see in a large cap fund, right? At close to a 10,000 or sub 10,000 level, I don't think the fund is anywhere close to facing a challenge at this point in time, specifically from that perspective. Of course, had this been a large cap fund where the focus was 80% in top 100 companies, this would definitely have been a red flag. But if you've seen that the larger part of the investment return that the fund really has been able to generate has been through international equity, specifically in the last 2 years. But the reason why the domestic part also appeals to me is because it is more value oriented right now. And in my approach at these high market valuations, I think a value fund should be able to do much better than a momentum or a growth fund. And that is my reasoning of why the domestic exposure also makes sense in Parag Parikh Flexi.
Got it. Well, gentlemen, this was lovely because it gives the viewers a sense of how they should approach building a specific portfolio. Now, viewers, the standard disclaimer would be that if you don't have a financial advisor, keep one. Try and get the best advice possible for you, because your case may be different. This is an average thing that we've tried to do so that you can benefit. And yes, what these guys are saying makes sense to a great extent. So I'm sure if it makes sense to you, please go out and try and take tips from this conversation and then see if it suits your investing style. But Mr. Mahajan, Kirtan, thank you so much, gentlemen, for joining in today. Lovely having both of you. Much appreciate your time.
Thank you so much. It was nice to be here. I'll just add one thing to this. Pafas we also like, and their style is totally different. They're not scared of being in cash. So, and there is a least overlap with other funds. So that is one of the greatest features of PPFAs. So that I think investors should keep in mind. It's an excellent fund, no doubt. But thank you again. It was wonderful being here, catching up with Kirtan and Neeraj. Nice meeting you.
Likewise. Thank you so much, Mr. Mahajan and Kirtan. Great having you again. Thanks so much for joining in. And to viewers, thanks so much for tuning into this leg of the Mutual Fund Show.
Thank you so much.
Thank you so much.